Hello. Well, first of all, thank you very much for taking the time and trouble to watch this sort of pseudo video that we have here. My name is Mark Fielding Pritchard, and that's a picture of me you can see over there on the right hand side. And I'd like to try and personalize this, even though it's basically a PowerPoint presentation. I am a partner in the firm of M.E. Fieldings, and there are approximately 10 of us. We have a whole stack of experience all over the world of doing IPSAS implementation and also of doing IFRS implementation. Please visit our website, please subscribe. If you're watching this and you think, oh my god, this is just not for me, well, maybe you have some friends, so please give them the links. Who knows, maybe they'll even thank you. The purpose of this is that on the website we sell training material, and I wanted to give you a little free sample so that you can see what we sell. So you can see here that in this presentation today we're going to be looking at employee benefits, and you guys can have this for nothing. There is, as you can hear, a voiceover, which is what you can hear being me. So should you purchase these things, you can disable the voice so you can do your own voices. You can change the slides as you wish because you'll have them in PowerPoint as well. And if you want some help from us, then part of the purchase price is that you come to us. Should you decide that you want some more stuff written, you can probably come to us and ask us, and we'll, assuming that you've purchased, we'll actually write some extra training material for you for free. That sounds pretty good, huh? The catch is that if you write some stuff, or rather we write some stuff for you for free, we do reserve the right to take that material and then sell it to other people. Obviously when we do that, we take out any confidential information that you may have put in that is only specific to your organization. So my name is Mark. You can find me and my colleagues at mefielding.com, where you should subscribe. There is free material on that site, and there is paid material, and you can use this for anything that you want. And once again, thank you for taking the time to listen to me. We do appreciate that you're all busy. Now what we're going to do is we're going to move into the presentation, and we're going to look at IPSAS as they affect employee benefits. If you have read, or if you have listened to presentation number 1, which is Introduction to IPSAS, then you should know what IPSAS actually are. IPSAS, very, very briefly, are accounting standards, and accounting standards tell us how we should treat, how we should present certain information for certain specific transactions. IPSAS that we're looking at today, therefore, is employee benefits. And employee benefits are all of the rights that employees receive as a result of their employment. So you can read the slide as well as I can. Most of these are very, very obvious. So they would be your salary, which you get every month. But there are numerous other benefits that we look at as well. Our business focuses mainly on NGOs, non-for-profits, and governments. So therefore you would normally expect to see pension contributions, you get holiday entitlements, and included in that will often be things like, particularly for NGOs, things like relocation. So you have someone who is from Britain, they are paid to relocate to a country like Liberia, and they work in Liberia for a couple of years. The question therefore is, how do we account for all of those benefits? So what do we actually do for all of those benefits? So you'll see that we've added now at the top there IPSAS number 25, because IPSAS 25 is the number of the accounting standards which governs employee benefits. I would have to say that the bulk of the standard relates to pensions and so on, and in general we do not recommend that you go away and read these things in great detail. But it's IPSAS number 25. Right, the reason that we need this is IPSAS, as you now know, number 25 relates to accruals accounting. Accruals accounting obviously different from cash accounting. So I've given you a couple of situations that I've seen in real life here, and this is why we need this standard. So it says situations that arise. Mrs. X is a project manager who is paid $200 a day. When we do our proposals to our donors and our funding agencies, What many NGOs do, therefore, is that they charge out Mrs. X, and when I say charge out, they put her in the proposal at $200 a day. But the thing is that Mrs. X gets a whole load of other things as well. So she gets a flight to fly into the country, she'll get some accommodation allowance, she may be eligible for a pension, she may be eligible for certain sums of money to pay back when the project is finished. And we have to make sure that we recover all of these costs. In terms of psychology, it's actually much easier for you when you're dealing with a donor if instead of putting Mrs. X in at $200, you just put her in at $300 into your proposal, into the budget that goes with your products and so on, and then you pay her $200 and you keep the $100 for the extra. You will find with some governments, particularly not so much the Scandinavian ones, but the ones that tend to be much more careful about their money, so you know the Dutch government and so on, that they don't like to pay these things. So it's easier to put her in at $300. And what you're doing when you put her in at some sum of money to keep it equitable and fair and in line with the accounting standard is that you are putting in sums of money which represent the full employment cost. So that's the first thing, it's this idea of full employment cost. The second thing is you'll see the last point there. It says she's eligible for a payment of $10,000 to move back to her home country. She works on a project for 9 years and 9 months. Then she shifts across to her final project for 3 months. If you're on a cash accounting system, what will happen is that the full amount of that payment will be charged to project ZXC, because that's who she's working for when she leaves. But you can see, therefore, that only 3 months of 10 years relates to that project. So what we need to do, therefore, is we need to accrue the costs of her as we go through the process. So you need to be charging to your projects, sums of money every month that represent her salary, plus all of these additional payments. And this payment at the end, which pays for her to go back to her home country, we would normally call repatriation costs. As we move into slide 4 there, have a look at the title, because the title kind of explains very well what we're doing here. We're looking, therefore, at what is the effect of IPSAS adoption. So in terms of moving away from old cash accounting and moving on to accrual-based IPSAS, what will be the effect, therefore, of adopting IPSAS on our employee benefits? So it says very nicely, IPSAS adoption will change the way you recognize employment expenses. And we kind of did this in the last slide. So this is what we're looking at. Under cash accounting, you just look at the amount of cash that you are paying people. So what do they get in terms of their salary plus the tax costs to your organization? Now what we're doing is that when we say recognizing, we mean recognizing in terms of our financial statements. So in terms, therefore, of our financial statements, we will have this cash cost, but we will add to the cash cost, other expenses which are being earned. Now notice that word, which are being earned, but which are not yet being paid. So things like annual leave costs, we will have pension costs, we may have insurance costs, and so on and so forth. So now, when it says what do we recognize, what's the number that goes into our financial statements, what's the number that goes into our accounts that relates to somebody's employment cost? And it's this total cost of employing them. So that's the first thing. The second thing there, which seems not to be in bold on this slide, is our pro forma cost revisions. Right? That's a very fancy term, and it means, once again, remember Mrs. X, she was going to be paid $200 a day, but when we put her in as a daily cost in our proposal for our donors, we increased it, and we increased it to $300. And the reason that we're putting that extra cost in, and the reason that we should do that it's fair and equitable and honest to do that, is because we are adding in, again, this idea of the total cost. So we're adding in the payments to get her home at the end of the project. We're adding in, at the end of the project, her pension contributions and any other sums of money that we pay for her. So this pro forma cost revision, your pro forma cost is how much does a person cost you every day. And if Mrs. X is being paid $200 a day, it's not $200 a day, because that is not the cost of her employment. The cost of her employment, or the cost of her consulting fees, is $200 a day plus these additional costs. So pro forma cost revisions, how much do we charge per day? Finally, the third one is that at the point at which you adopt IPSAS, so if you are moving here through adoption, you will have to have an opening balance, because IPSAS demands that if you have someone who's worked for you for 5 years, and in that 5 years they have built up a pension, so a fund, a sum of money you're due for pension, you have to recognize that as an opening liability. So on IPSAS adoption, what is your opening liability? So how much do you owe people who already work for you? And that has to be recognized as well. Okay? So the effect of IPSAS adoption will give you those three things: the changes in the expenses in the accounts, the changes in your budgets, and these opening balances that you have to have. And that's going to be big, because you're going to have to quantify those. Please do remember, we offer all of these services and we have experience of all of this, so come and ask us if you need any help. Okay, so what we have here now is we have a calculation of the standard cost after IPSAS implementation. So let's assume that what we have is we have Mrs. X. If you remember Mrs. X, we were going to pay her $200 a day. Now what we do is we have to say, okay, well, let's assume that we have a project, and the project is going to be financed by the European Union, for example. We have to put a budget in. Mrs. X has agreed, she has the correct technical background, etc., etc., and we're going to pay her $200 a day. Right, what is the cost that we put into the budget that we send for approval to the EU? Well, we've already said that the cost will not be $200 a day, because it needs to include all of those other amounts for other costs. So these here are standard costs. Now these are just examples. You're going to have to calculate these numbers yourself. And in fact, in practice on introduction, usually what most people do is they take some kind of pluck a number from the air, and then they keep some statistics and looked at the costs at the end of the year. So you're going to have to design this table with your costs and your percentages yourself. I suggest you do it fairly kind of loosely the first year, keep some statistics, and then in the second year, once you've got some basis of calculation, you can then do some more accurate figures. So we said to Mrs. X, $200 a day. In addition to that, we have to make some pension contributions. So we've assumed here that it's going to be 5% of her $200. So 5% of $200 is $10. So we're going to add $10 a day to her cost for pension contributions. In addition, because she's going to be in Liberia, there's still 13,000 UN troops in Liberia, so we've got some security costs. This can either be the cost of guards, it can be the costs of, who knows, cost of also things like malaria tablets and medicine, and it can be cost of insurance for her if anything happens to her while she's working abroad. We've estimated that at 4%. End of service here will be things like repatriation, relocation, any sums of money that we have to pay her at the end of her contract, which are due, or bonuses. Sometimes on projects as well, if the project is successful, you pay your consultants a bonus at the end, so this may be for bonuses, whatever this is. Learning, we're adding 1% to make some contributions, so there's going to be some training courses. Certainly if you're working for any major international organizations like World Bank, you're going to have to go on security training courses. And if she particularly, even if she's doing gender equality, she has to learn something about accounting, 1% for training courses, and 1.5% for IT. Even for consultants these days, it's sometimes common for larger organizations to provide them with in-house laptop computers and so on. So we're adding 1.5% for IT support. So we got our calculations there for things which are costs that relate to her employment. Notice that we have an extra category there as well, which is contribution to other activities. This, when it's set up, can mean one of two things. Very often what happens is that if we are using office space in the common office, then we will be recovering some costs from this project for common office space. Again, it depends on who your donor is, but some donors don't like to pay for this. So some donors don't like to pay for this. Other donors are quite happy to pay some admin cost. I know that the United Nations usually pays between 8 and 10% as an admin cost. Some donors won't do that. So you include it in the daily rate as an employment cost. So that's one thing that we can have here. You'll see therefore that it very quickly adds up. We've got here 16% of her total cost. So if she's being paid $200 a day, in addition to that you're now adding another $32 a day. That's 16% of $200 for those other items. Notice that if Mrs. X gets annual leave, we need to add annual leave cost as well, because Mrs. X is going to be paid for certain days when she's not actually doing any work. So we add the cost of annual leave. The main reason is that we must recognize annual leave as a liability of the organization, and we recognize this as a liability of the organization because if she gets to the end of the project and she hasn't taken her annual leave, then what will happen is that we have to pay it to her. And if we have to pay it to her, then we have a cash liability. So we have added here another 10% of her salary for annual leave, which gives us 26%. If Mrs. X is being paid $200 a day, therefore, what we put in our proposal to the EU, as we said, is not $200 a day, but $252, because 26% of 200 is $52. Okay, this looks like a very, very complicated slide, but it's actually very, very simple. In our example, we had Mrs. X. Now, Mrs. X, we said, was working for our project. And let's assume that Mrs. X earns every month 2 days of holiday. What we do is we put through, first of all, an entry every month. So every month we charge the project that she is working on with 2 days of holiday. So the project has a cost, and the cost is 2 days of holiday for Mrs. X every month. That's our first entry. The second thing that we do is that in the month that Mrs. X actually takes her holiday, we reduce the amount of cost to the project. So we put a credit through. So let's assume that for 5 months she works and takes no holiday. Every month for 5 months we will add the cost of 2 days holiday. So therefore at the end of 5 months she has 10 days of holiday taken. In month 6, let's assume that she takes 7 days holiday. So in month 6 we will again charge our project with 2 days of holiday. But then we will credit the project with 7 days taken. So the effect in month 6 is that there will be a net credit to the project, and remember it's going to appear like income of 5 days of holiday. Okay, so we get this charging every month of Mrs. X's work of 2 days and then crediting the project when she actually takes holiday. Therefore, that's how we get into the project the cost of her annual leave. And there is your cost. Okay? Right, notice on our slide it says effect. So therefore it says a potential increase in the staff salary costs if the accrual is greater than the leave used. So in the first 5 months we will have this cost. Now remember, it's not a cash cost charged to the project. We're not charging actual cash. We just have this idea of an accounting entry. Okay? Finally, notice that there's benefit to the project if an employee forfeits annual leave. So if an employee does not use all of their holiday and then they don't get paid for it, we actually have a benefit to the project. Okay? So that's annual leave. This idea of 2 entries, every month we charge the amount of annual leave that a person has earned, and then we credit to the project when they actually take the holiday. So in slide 7, we just have a little update there, or a little summary, and it says impact on processes. So if you are working in an HR department and this is coming for you, this is the kind of things that you're going to have to pay attention to. Your accounts department is going to have to calculate for you at some point an accrual. So therefore an accrual simply means in this sense that they're going to have to add up what the total owed of annual leave is. Now what's really important here is that your records are accurate. Particularly in NGOs where you have people out in the field, the amount of holiday that they have and the amount of holiday that they've taken can very, very quickly get out of sync. So therefore you need to do periodic sweeps, and sweeps mean you get everyone to send you in a list of how many days of holiday they think they have. And you have to make sure that your computer system, assuming that you're using a computer system to monitor this, is up to date and accurate. So you'll see on the slide there it says timeliness of entry of the annual leave data is important, because once your balances start to get way out of sync, then you'll find that your accounts become meaningless, your project costs become meaningless. So therefore make sure that your finance department is ready to calculate those accruals. And they'll be able to advise you how to do that. Right, other little things where we get problematic areas, right? Hiring of staff from other departments. Right, what's happening here is that when you're calculating your accrual, and let's assume that you're in an office in a country like Sierra Leone, you will have people joining you who are coming from headquarters in America or Switzerland or wherever, or people who are coming from other country offices. When those people come into your office, they will bring with them their accrued holiday. So that you can properly report on this, you need to know what those balances are. So it says there, update of the accrued annual leave balance. So you need, when someone is joining you, to make sure that if they are coming from somewhere else in your organization, you get a note of what their accrued holiday is. Now on the slide you'll see that it says that no automatic update of GL. The GL means the general ledger. The reason is because you are keeping manual records for your office or your department, but the GL will actually record the total for the organization. Right, in terms of the total for the organization, somebody moving from Malawi to Sierra Leone doesn't affect, because it's the same. It doesn't matter where they are. The number is all that's important. What is important though is that in your office, for recording purposes, that you have to keep these totals. So that's why it means for your office it is important. For the organization as a whole it's not. Now notice the final thing that it says there. It says manually bill the releasing department. If that person has accrued, so a person is coming from Malawi to Sierra Leone, and you have an accounting system that only recognizes Sierra Leone, so in other words, if your person works in a project for you, then quits and has to fly back to Switzerland, has to fly back to Scotland or wherever, you need to get the amount of the liability to date. So you need to calculate how much relocation, how much repatriation, how much holiday. You're actually going to need them to send you the money that has been accrued to date, because that is the old office's share of those costs when they come to the end. Right, if that's starting to sound confusing, the website's on the bottom of the slide. Contact us, we'll give you a template and we'll explain to you what you're doing. Okay? But please bear that in mind. So, point number 2, where it says on the slide, hiring of staff from other departments. You're in Sierra Leone, you're hiring someone from Malawi. You have to get a sum of money and a note of all of these balances. If you have the opposite situation, so someone is leaving Sierra Leone and going to Malawi, then you need to do the opposite. You need to send them a note of how many days repatriation, how many days, blah, 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 of accrued holiday, etc., etc. And you will have to write them a check. So make sure that you actually have the cash in the bank to do that. Okay? Once again, if that's starting to sound confusing, you know where we are. Okay, what we've got here on this slide now is we've got the process. So what do you actually do at work if we're just looking at annual leave? Now that we really just look at annual leave, because in most organisations, even if you look at the Red Cross and so on, you'll find that the country offices and so on look after holidays, but often things like repatriation are centralised. In this system, and a terrible thing to say, but this is, even in large organisations, this is usually how it works, is that people keep two parallel systems. And that's what you're seeing on this slide. So the first system, which is the one at the top, is a paper system. And the one at the bottom is the system in the Oracle system, or whichever accounting system your international organization or your NGO has. So if you just have one, and I'm assuming if you just have one it'll be paper, you just need to look at the top of the slide. But if you have two, and normally you are required to keep two, and auditors will ask you to keep two systems, then you need to look at both. So the system is fairly straightforward for paper. Just look at the very top line, you can see the three green arrows going from left to right. So therefore Mrs. X decides that she wants to use some of her annual holiday, so she generates a request. Usually therefore there's a standard Word document. She writes on her piece of paper the days off that she wants, and she submits that to her supervisor. The supervisor will normally check that she has enough leave in her leave balance, so there will be a leave monitor, whatever that person is called in the office, and assuming that Mrs. X has enough holiday, the supervisor approves by signing. What happens at that point, therefore, is that it is recorded manually. Many offices, even in large organisations, have paper files. So therefore, Mrs. X will have a balance brought forward at the start of, this is September, so the start of September. We add on her 2 days a month holiday for September, and we deduct the number of days taken. And that number will be either kept and filed, or hopefully it will be compared to what's in the computer system. But whichever way it goes, that will be retained and will be confirmed to the finance department, to the accounts department, when they prepare their annual accounts at the end of the year. So we've got this idea, therefore, that assuming our organisation or your organisation has a calendar year, that through the year we are adding on a certain number of days on a paper copy or an Excel copy every day, and then at the end of the year we can deduct, we deduct the number of days she's taken, and there is a balance at the end of the year. You can set this thing up very easily in Excel. If you want any advice on Excel, go to the website, look under free material page, company called Chengdu. Send Chengdu an email and Chengdu will tell you how to do it. If you really want to talk to me, send me an email. I'll get Chengdu to get you an email and we'll work through it together. Okay, that's first. Right, so that's the paper system, the nice easy one, and the one I imagine most people use. The second system is the computer generated system. Most large organizations will have something based around SAP or Oracle. If you have a SAP or Oracle system, you can go into the system and it will be called My HR module, something like that. The system will add every month to your balance the number of days, and you will have to generate a computer request for a certain number of days of holiday. That will be automatically forwarded to your supervisor. If it works like most organizations, your supervisor will trot round the corner to the leave monitor, ask whether or not you have enough days, if you have enough days, and in fact certainly SAP will show you that you have enough days, and they will click the approve button. That will forward it to the finance department, and it will also forward it to the payroll department, assuming that they are separate. This is if your organization is large enough. When you get your payslip will therefore show your number of days available at the end of the month, and the number of days available at the end of the month in the computer will be matched to the number of days in the paper. So you should always check that these things are correct. So we have two different workflows there, one for a paper system and one for a computer system, though most organizations have those two things running in parallel. Whew. Okay, once again, what looks like a monstrously complicated slide, but really isn't, is relocation grant. Right, relocation grants occur for many staff of NGOs and international organizations, and they occur where you are required to work on a project. The project is based in, where did we get to, Sierra Leone. You are Scottish or American or Indian or Russian, so they pay a sum of money for you to come from India to Sierra Leone. That sum of money is expensed immediately usually. But in addition, there will be a sum of money due to you when you finish your project, which will be some combination of an airfare, and often many organizations like the World Bank pay sums of money to you so that you get a paid month's salary at the end while you look for a new job, and so on and so forth. Right, your relocation grant, therefore, which is what I'm going to use the term for all of these payments which are due to international staff at the end of a project when they quit and go back to their country. And please do remember that it may not always be quit, go back to your country. You're working on a project in Sierra Leone and then you get sent on a project in Zimbabwe. They still have to move you, so they have to pay for your furniture to move, they have to pay airfares for you and your family and so on. It's all the same. Right, we had Mrs. X. What will happen to Mrs. X is that while Mrs. X is working on the project will be charged with a sum of money every month to cover the cost of her relocation. So remember we said I think Mrs. X was getting paid $200 a day. We were adding another $52 a day of cost to the project. Can you see therefore if Mrs. X is earning $200 a day, but we're charging $250 to the Norwegians or whoever were the donors, there's going to be unspent sums of cash at the end of the project. Right, those unspent sums of cash will be used to relocate Mrs. X either back to her country or to another project. So what we do therefore is every month as we're paying her, we charge the project with some cost. And there will be, in terms of debits and credits therefore, we debit an expense into the project and we credit a liability in our balance sheet. That liability, in our statement of financial position rather, therefore will be used at the end of the project. So we debit that liability and we credit cash when we pay all of the money that's due to move this lady to wherever she's going. And that is what all of that fancy slide means when it starts talking about repatriation grant and so on and so forth. Please note that your finance department therefore will have to know what all of this is, and they will have to set up account codes in their chart of accounts to make sure that all of this is covered. That was easy. If you don't understand, you know what to do. You know where we are. Okay, so the slide really starts to talk about termination here, but it's not 100% relevant all the time just for termination. The slide is just really reinforcing what we learnt in the last thing. So let's assume that we have a member of staff and the member of staff is leaving. They've been on a project for a couple of years and they've been in Sierra Leone, wherever we were. If they are due relocation allowances, so they're due sums of money to get them back to India or Russia, wherever they're from, we hope therefore that we have accrued the full amount over the life. So we've charged the project every month and we've built up this liability account. So all this slide is telling us, and if you look actually at the second point, it says if the accrued entitlement is paid through accounts payable. All it's telling us therefore is that when we pay their relocation, we credit cash and we debit this liability account, and hopefully the liability account will be enough to cover the full cost of the relocation. Just moving up the slide to the first point, it says in the relatively unlikely event of non-payment of salary at December end or on termination. The CO is the country office. Right, so our country office therefore will expense the entitlement to recognize the liability. Again, it sounds horribly complicated. Right, let's assume you have a driver. The driver's overtime has not been approved as at the 31st of December. What we need to do therefore is approve it And therefore, when we approve it, we will debit the project the driver works on, and we will credit liabilities on the 31st of December. Now, we must do it at 31st of December because the assumption is that's the year end, so to go into the accounts. When the guy is paid, therefore, so when your driver is paid, you will then credit cash and debit that liability in the liability account. So nothing new there. If there is anything, again, it's saying here which has not been accrued, then we have to make sure that the expense goes into the expense accounts. Again, it sounds really horrible, but it's really straightforward. If you have any questions on that, let us know. And once again, we will do our best to give you some advice. And finally, my God, you'll be so pleased, slide number 11. Right, the summary. What do you actually need to know about all of this stuff? Right, first of all, you must know what the word employee means, because employee is a member of staff. Now remember, there will be different contract types, and we are talking about the cost of employees with what we are doing here. This may be different for the cost of consultants. Now, I've talked all the way through about Mrs. X who gets paid $200 a day. It is probable that Mrs. X is going to be a consultant. So it may be that you have different processes. So make sure that you understand what we've shown here, who it affects. Second one, this is so true. And in fact, this doesn't really matter if you have IPSAS or not. When you're looking at people's salaries and you're looking at people's holidays, you should have good quality of data. Because if you start getting people's salaries wrong, pay them too much, no one ever complains. Pay them too little, except the auditors. Pay them too little, and they're going to find that out very, very quickly, and you're going to know very, very quickly. So make sure you keep your records. Annual leave is a big one as well, because it's so difficult to follow. Once you get 10 or 15 people, so hard. Right, number 3, record the appropriate account codes correctly the first time. Right, you do have to get your account codes correct the first time. A number of organizations I've worked in where suddenly someone pops up on one of your projects as a cost and they're in an office on the other side of the world. But do watch that. And in particular, make sure that there is sufficient funding as part of your process in your management system. You will find usually that your computer system is monitoring 2 things. So you have a project, and within that project it will compare what you are spending firstly to the amount of cash which is allocated to the project, and secondly to the budget. And your accounting system, certainly if it's SAP or Oracle, will allow you to spend the lower of the amount of cash or the budget. If you start getting budget error messages coming up, you need to flag that and find out why. If it's salaries, many large organizations, again the World Bank and so on, will allow you to hit the override button to ensure that your staff get paid. Right? If you're hitting the override button, please go find out why it's happening, because otherwise, you know, most NGOs are not allowed to have overdrafts at the bank, so you're going to hit a point when people are not getting paid if you're not careful. Okay? Right, understand the impact on pro forma costs and be able to explain the increase. Right, you need to be able to explain what is included in your daily rate cost. So remember, Mrs. X was getting $252. You need to be able to explain what's in there and why. So have those arguments ready. If you are dealing with donors, certainly from Europe, and now of course we've got countries like Russia coming into the donor environment, these guys know all about accrual accounting. I mean, the best IPSAS systems in the world are in New Zealand and Australia. So if you're starting to talk to them about what you're doing, they're going to get it. But make sure that you can answer the questions. Okay? Right, your work processes to capture the required data or information. And this happens so often, particularly in countries or organizations who are adopting IFRS, adopting IPSAS, but they're trying to do it without really spending any money. Suddenly you find that the workflow does not provide the information that you need. So make sure that you're sure at a detailed level that it does. Finally, for those of you who work for governments, for those of you who work for large organizations, you will usually find that the process to gather the information is what you are interested in, and then suddenly your computer system or your HQ, or if you're in a government, your regional accounting center or whatever, does most of the work for you. So make sure that you're comfortable with your part, but you should know what the other guys are doing as well. Okay? But if you're lucky, most of the work done here, you can see the American by leveraging the ERP or by HQ. Okay, thanks guys. That's a long chat there. That's a training course. As I said, my name is Mark. You even have my picture, but you also have my contact details. Please, if you want stuff from us, get in contact with us. We do our best to provide it. We know the great work NGOs do, so we do provide certain limited amounts of stuff free. But unfortunately, my kids require shoes, so we do have to ask for payment as well. If you're looking at this, you sat through it, you finished your lunch, you're thinking, yeah, it was okay, but not that great. But you know someone who it's relevant for, send them a link, get them to subscribe. We send special training material just to subscribers because it's a good test for us. If you're looking for consultants or something, we're available. We're all looking for work. Thank you very much for your time. Been a pleasure to meet you. Goodbye.